How to avoid estate and death taxes, securing your legacy with an irrevocable life insurance trust. You've worked hard to build your wealth, your legacy, and your family's future. But without proper planning, a large portion of it could disappear into death and estate taxes. The good news, there's a smart, strategic way to protect what's yours. In today's video, we're diving into how you can avoid estate and death taxes using a powerful financial tool, a life insurance policy, combined with an irrevocable life insurance trust. Stick around because what you'll learn today could save your family millions and secure your legacy for generations. What are estate, death, and inheritance taxes? Let's start by breaking down the problem so we can understand the solution. Estate tax. This is a tax on the total value of your assets at the time of your death. If your estate exceeds the federal exemption limit, your heirs may owe taxes on the amount above that threshold. Now, some states also impose their own state estate taxes, which can further complicate matters. For example, in Massachusetts, taxable estates are over $2 million. Inheritance tax, this is a tax levied on the individuals who inherit your assets. While not every state has an inheritance tax, for those that do, the rate depends on the relationship between the heir and the deceased. Death tax is a term often used to describe both estate and inheritance taxes. Death tax is a term used to describe both estate and inheritance taxes. The federal estate tax exemption in 2017 was raised from $5.9 million to $11.18 million per person. With inflation adjustments in 2025, the federal exemption is $13.9 million, which means federally you are only taxed if your estate is over $13.99 million when you pass away. However, if you live in a state like Massachusetts, that has its own threshold, for example, $2 million, and your estate will be taxed if you die as a Massachusetts resident over $2 million. It's also important to note that the 2017 change is set to expire December 31st, 2026. As we get closer to 2026, you're going to hear a lot on the news about legislation to extend this. Now, why combine life insurance with an irrevocable life insurance trust? Life insurance on its own is a valuable tool for providing liquidity and financial stability. And when you combine it with an irrevocable life insurance trust, it becomes a strategic powerhouse that can help avoid estate and death taxes while protecting your legacy. The key benefits of life insurance in an irrevocable life insurance trust. Number one is the tax-free death benefit. Life insurance held in an irrevocable life insurance trust is not included in your taxable estate, which means your beneficiaries receive the entire death benefit tax-free. So for example, suppose you have a $10 million life insurance policy. Without an ILIT, the policy might push your estate over the exemption limit, triggering taxes. With an irrevocable life insurance trust, also known as an ILIT, that $10 million passes to your heirs tax-free. Number two, immediate liquidity. Estate taxes and debts are due shortly after you pass. Life insurance held in an ILIT provides the necessary cash to cover those expenses without forcing your family to sell off valuable assets. For example, let's say you own a $5 million family farm. Without liquidity, your heirs may have to sell the farm to pay the taxes. With an ILIT funded through a life insurance policy, they can use the proceeds to cover taxes and keep the farm in the family. Number three, creditor protection. Assets held in an ILIT are protected from creditors, ensuring your heirs receive the full value of the life insurance. For example, if your estate is tied up in any lawsuits or debts, the proceeds within an ILIT cannot be touched, safeguarding your family's financial security. Number four, customizable distribution. An ILIT gives you control over how and when your beneficiaries receive the money. You can structure the payouts to fund specific milestones like education, home purchases, or to provide steady income for decades. For example, if you're concerned about your child mismanaging their inheritance, you can set conditions such as releasing funds only for educational expenses or in annual installments. Number five, support business succession planning. For business owners, an ILIT can provide liquidity to equalize inheritance or fund buyouts. For example, if you own a $15 million business and have 3 children and only one works in the business, an ILIT funded by a life insurance policy can provide cash to the other 2, ensuring fairness without disrupting the company's operations. Number 6, building a long-term legacy. With an ILIT, you can create a financial plan that supports not only your immediate heirs, but also future generations. For example, your ILIT can fund a trust for your grandchildren's education, or create a charitable foundation that continues your philanthropic efforts for years to come. So how does an ILIT work? First, you create the trust. You work with an estate planning attorney to establish the Irrevocable Life Insurance Trust. You'll set the terms, name beneficiaries, and appoint a trustee to manage it. Next, you'll transfer or purchase a life insurance policy. You can either transfer ownership of an existing life insurance policy to the ILIT or have the trust purchase a new policy. This step ensures that the policy is excluded from your taxable estate. Annual funding for the premiums is the next step. Each year, you'll make a tax-free gift to the ILIT to cover the insurance premiums. These gifts typically fall within the annual gift tax exclusion, further reducing your taxable estate. Distribute the proceeds. Upon your passing, the ILIT ensures the tax-free distribution of the life insurance policies according to your wishes. Upon your passing, the ILIT ensures tax-free distribution of the money according to your wishes. The time to plan is now. Every day you wait is a missed opportunity to protect your wealth and secure your legacy. With an ILIT, you can minimize taxes and maximize what your heirs receive, ensuring your family's financial future, safeguarding your assets from creditors and mismanagement. If you're ready to take control of your financial legacy, be sure to check the resources I've shared in the description. If you found this video helpful, don't forget to subscribe, like, and share. If you have any questions, drop them in the comments, and I'll see you in the next video.